So what we're going to do today is we're going to pick up from where we left off last week. Last week, we were focusing on the non-refundable tax credits. And the next one that we're going to look at is the one that deals with medical expenses. So the government says that if you pay for a lot of medical expenses for you, your spouse, your family members, then you'll get a tax credit. And on your rates table, let me just sort of pull up the rates table quickly just to sort of show you the main tax credits that we're going to be focusing on in this question. Let's see here. So this is the rates table. If I bring it back to page 1, this is page 1. Those are all the federal tax rates that we use to calculate the federal tax liability. And then starting on this page, we have the federal tax credits. Remember, we said that there are provincial tax credit as well, but everything sort of just follows through from the federal amounts that are calculated. So if you're using income tax software, once you confirm all your federal amounts, then the provincial amounts will basically just self-populate. There are some exceptions where there might be a provincial tax credit where there's no equivalent federal, but those are sort of the exceptions. And so we're just going to focus on the federal tax credits for this chapter. If I scroll down to page 3, the ones that we're going to sort of talk about today first is the medical expense tax credit, and then right below that, the disability credit as well. So for the medical expense tax credit, you see this formula 15% times bracket B minus C and a bracket plus D. And then you see that under D, it equals E minus F. So that's sort of the formula we're going to be using to calculate the medical expense tax credit. And then also the disability tax credit right below that. The one that everyone gets if they have a disability is the all ages one, $9,872. And then if you are under 18 and you also qualify for the disability tax credit, then you also get a supplement, which is 15% of $5,758. So we're going to be looking at these tax credits in the first problem that we're going to be doing today. So I just wanted to point that out to you as to where those are found on the rates table. So let's go back to our Excel document and let's talk about that formula that we just saw. So in your textbook, they sort of give you this formula. A times, in brackets, B minus C plus D. Now, A basically is 15%. So remember we said that most tax credits, you just multiply by 15%. So that's what the A is. And then we have B minus C. B is your eligible medical cost. So those are all the costs that are deemed eligible for the medical expense tax credit. And then minus C. C is the lesser of these two amounts here. So C is the lesser of 3% of your net income and $2,759. What this is trying to do is saying that there needs to be some level of medical expenses that you pay for yourself. But once you cross that threshold, then you can claim those medical expenses. That's where we get the B minus C. So B is all your eligible medical expenses minus C. C is the lesser of 3% of your net income and $2,759. So if your net income was, let's say, 100,000, then 3% of that would be 3,000. And the lesser of these two amounts would be the 2,759. So if we take 2,759 and kind of divide it by 3%, we're going to get 91,967. So 91,967 times 3% is 2,759. So what this is saying is that once your net income hits over 91,967, the lower of these two amounts will be the 2,759. So in this case, this individual, the C amount would be 2,759. So this medical expense tax credit would only be valid if the B amount was greater than 2,759. If their medical expenses were only $1,000 and the C amount was 2,759, they would not be able to claim the medical expense tax credit because B minus C would give you a negative number. So this is just basically saying that there's some level of medical expenses that you have to sort of bear the cost entirely on your own. And once you sort of exceed that C limit, then you can start claiming the excess amount for this medical expense tax credit. The D amount is only applicable if you are paying for medical expenses for dependents that are over 17. So your B amount would include your medical expenses, your spouse's, and any children under 18. So let me just make some notes here. So B would include all of the taxpayers' medical expenses, along with the spouse, and children under 18. So the taxpayer is paying for the family's medical expenses, then the taxpayer could claim his or her medical expenses, their spouse's medical expenses, and also any children under 18. Now, the D amount applies if, let's say, the taxpayer is still paying for the medical expenses for one of their children, but the children happens to be over 17. That's sort of when the D would apply. Now, we're not going to see the D amount in this first example, but we will see it in the later example that we do after this first one. So let's have a look at this first example. We have this taxpayer, Clarice, and Clarice has net income of $132,400. Now, we're going to assume that her net income of this amount also equals her taxable income. So one thing that we learned all the way back in chapter 1 is that when you're tackling these sort of income tax liability problems, you need to first sort of make sure that the net income for tax purposes is calculated. This has already been done for us. Once you calculate net income for tax purposes, you want to then calculate taxable income. Now, we're just going to assume that the amounts are the same for this particular question. And so those calculations have been done for us. Our goal then is just to figure out basically what Clarice's non-refundable tax credits are, and then what her taxes payable will be after those non-refundable tax credits. If we continue on, all of her income is employment income, except for the deduction of CPP 838. So all this is saying is that we talked about CPP, and we said that if you get the maximum CPP deducted, then a certain amount, $3,218, will be used as a tax credit, but then the additional amount, the $838, would be a deduction when you calculate net income. So all they're saying is that when they calculated this net income, it's all employment income, but they've already deducted that 838 to get to the 132,400. So the 132,400 net income has already been done for us, and we're just going to assume that that equals her taxable income. Her employer withheld maximum EI and CPP. So we know that when we calculate the tax credits, she's going to get the maximum EI CPP tax credit. She has a husband and 2 kids, and none of them have any income. The 13-year-old was severely injured in a car accident 2 years ago and qualifies for the disability tax credit. So if an individual is disabled and they want to claim the disability tax credit, usually it requires a medical practitioner, a doctor, a nurse, to certify that this individual does meet the threshold required for the disability tax credit. So we're assuming that that has all been done. This 13-year-old child qualifies for the disability tax credit. But once again, the husband and the kids, none of them have any income. So if you think about it, even though the 13-year-old qualifies for the disability tax credit, it may not do the 13-year-old any good because that 13-year-old has no income. We continue on. Clarice also spent $12,500 installing wheelchair ramps, basically just to make the home more accessible for the 13-year-old child who is disabled. She also spent the following amounts for various medical practitioners, for her, her husband, and the two children. Now, because of her company medical plan, she got 11,000 reimbursed, so only 12,165 could be eligible for the medical expense tax credit. So that's the problem. Now, in terms of what expenses are eligible, in your textbook on page 219, they talk about just this list here of qualifying medical expenses. Now, this is not an exhaustive list, but it sort of gives you some idea of things that would qualify. Now, we sort of scroll further down. I also sort of cut a paragraph in this area of the textbook as well, basically just sort of identifying that anything incurred for purely cosmetic reasons do not qualify for medical expenses. So for example, if you get some teeth whitening done, even though it's done by a dentist, if it's purely for cosmetic reasons, it would not qualify. So that's sort of an easy way to sort of think about how to identify what would qualify and what would not. Now, in terms of the disability tax credit, we talked about the fact that this 13-year-old child who is disabled qualifies for the disability tax credit, but that 13-year-old has no income of their own. So also in your textbook, I cut out this passage from page 223, 224. And what they say is that if you qualify for the disability tax credit, but you do not have enough income to generate tax payable to use up the tax credit, then you can transfer that disability tax credit to maybe a spouse or someone who's supporting you. So in this example, the mother, Clarice, is supporting the 13-year-old disabled son. So that amount, the whole 9,872, can be transferred to the mother. Now, there's also that supplement as well. Remember from the rates table, we looked at that supplement amount as well. That supplemental amount, 5,758, can also be transferred to a supporting person as long as the disabled individual does not need the tax credits, him or herself. So that's sort of what we're going to be sort of using when we figure out Clarice's non-refundable tax credits. Any questions about the facts of the case first? So then why don't we just sort of start similar to what we did last time? We're going to assume that her net income for tax purposes equals her taxable income, and that has been calculated for us, which is 132,400. So using your rates table, calculate the federal tax before tax credits. And so once again, use your rates table and see if you can just sort of follow along using your rates table and come up with the same number that I come up with. I'll sort of give you what the final answer should be. The federal tax before tax credit should be 25,206. So just sort of see if you can come up with that number, and then I'll start sort of putting in the calculation down here as well. So remember, using page 1 of the rates table, figure out which row you're in. So for this one here, they're going to be above the 111,733. So we take the 19,833. And then for the amount over that, which is going to be at 26%. So the amount over that will be 132,400 minus 111,733. And we work through that calculation. That's going to give us the 25,206. And once again, as I'm going through this, feel free to stop me if you have any questions. Then we have the non-refundable tax credits. And once again, the one that everyone gets is the basic personal amount. And remember, Clarissa's income is 132,400, so it's below that threshold. So she's going to get the full 15,705. She's also the higher income spouse, so she can claim the spousal tax credit. And so once again, that's 15,705. That's her BPA. And remember, the spouse has no income, so there's going to be no reduction. So another 15,705. Now, at this point, sort of think about what her income is. In this example, all of her income is employment income. And it says in the question that her employer withheld maximum EI and CPP. So the EI, CPP maximums, once again, find that on your rates table. For EI, it's 1,049. For CPP, it's 3,218. And then also remember, if you have employment income, you can also claim the Canada employment amount. And so the Canada employment amount is the lesser of your employment income, and 1,433. So that would be the lesser of the two. And so those are sort of the most obvious ones because she has employment income. Those three tax credits, once again, are quite obvious. Now, we talked about the disability tax credit for the 13-year-old. Because the 13-year-old has no income, it can be transferred to a supporting person. And so in this example would be Clarice. Clarice is the only one that earns money within the family. So she is supporting her husband, also the two kids. So the disability tax credit can be transferred to her. And once again, the amount that's given on the rates table, 9,872. And because this 13-year-old is under 18, the 13-year-old would also qualify for the supplement. So that supplement, transfer of disability supplement, can also be transferred to Clarice. And once again, the amount that's given on your rates table, 5,758. One thing to sort of note is, remember we talked about infirmity, and we had that infirmity is sort of a lower threshold. And so we talked about the fact that if somebody has an infirmity, you'll sort of be told that in the question. But if they have a disability, that's a higher threshold. They would also meet the lower threshold of infirmity as well. And so I'm just going to quickly bring up the rates table and just sort of, as you're sort of going through studying and when it comes to the exam next week, just sort of, if you have a question that deals with tax credits, just look at your rates table and then just quickly scroll through to see if you missed anything. So we talked about the BPA, we talked about the spousal. Now the eligible dependent, you can only claim that if you're single or widowed and you don't qualify for the spousal. So the eligible dependent will not matter in this case because Clarice is married. And in the very bottom, we have Canada Caregiver Credit for child under 18. Something that we talked about last week, we said that if all your children are healthy, you cannot claim this tax credit. But if they have an infirmity, you can claim 2616. Now, because the 13-year-old has a disability, it also meets the definition of infirmity. So we can claim that as well. The other tax credit that we're going to talk about, if I scroll down, is the home accessibility. So you sort of see here, I'll sort of just put it 3 from the bottom or 3 from the bottom. So if you look at the bottom and just go up 3, you'll see the home accessibility credit, 15% of the lesser of 20,000 and the amount of qualifying expenditure. So I'll talk a little bit about the home accessibility. I'll bring us back to our Excel spreadsheet. So let's put in the Canada Caregiver for child under 18 first. And so once again, that amount was 2,616. And then I'll talk a little bit about the home accessibility tax credit. And I kind of just cut out something from the textbook right here, page 215. Although the CRA website does not provide a list of qualifying expenditures, it does provide a list of some expenses that are not eligible, such as outdoor maintenance, electric home entertainment devices. Some renovations would clearly qualify. Some renovations that would clearly qualify would be wheelchair ramps or lifts, walk-in bathtubs, wheel-in showers. So this home accessibility tax credit was introduced several years ago, realizing that a lot of Canadians need to make their home more accessible for maybe seniors, for maybe family members that have disabilities. And so this tax credit is the lesser of 20,000 and the amount of the qualifying expenditure. And this talks about wheelchair ramps. So if we go back to the question, this 12,500 wheelchair ramp would qualify for the home accessibility. So let's just sort of put that down in our list of tax credits, 12,500. The only thing that we're left to do now is the medical expenses. And once again, if we go back to our formula here, we have A times in brackets B minus C plus D. D is only applicable for dependents over 17. So in this case, we're only concerned about B minus C because B would include all of Clarice's medical expenses, along with her spouse and the two kids because they're under 18. So D is not applicable in this situation. And once again, the A amount is just the 15%. So similar to sort of what we did before, we're just going to add up all the tax credits and then multiply it all by 15%. So what we need to do now is figure out what is B minus C. So let's look at the medical expenses. And figure out what is B minus C. So B is, once again, all the medical expenses for the taxpayer, the spouse, and children under 18. And so we go and look at our question. That's going to be the 12,165. That's the amount that Clarice paid for. Now then there's the question, does the 12,500 also qualify as a medical expense? And if it does, can they claim it for both the medical expense and home accessibility? So again, let's go back to the passage I cut out from the textbook. Let's look at this paragraph here. Some expenditures would qualify for both this credit and the medical expense tax credit. For example, the cost of installing a ramp for somebody who's in a wheelchair would qualify for both. The legislation is clear that in this case, it can be used to determine the base for both of these tax credits. In effect, this results in a double credit for the same expenditure. So that 12,500 can be used for the home accessibility. It can also be used for the medical expense tax credit. So what that means is, for this question, we're going to take the 12,165 plus 12,500. That's going to be our B amount. $12,500 plus 12,165. So the B amount then is going to be 24,665. And then we have minus C. C is the lesser of two amounts. The first amount is 3% of her net income. Now, once again, we were told that her net income was 132,400. So that's going to give us 3,972. And the second amount is given to us, 2,759. That's given on the rates table. So that's sort of a set amount. And so we have B minus C. So the lesser would be 2,759. So B minus C, we'll put that right here in this box right here. That's going to be 24,665 minus 2,759. So 21,906. Any questions about the medical expense tax credit? So once again, fairly straightforward. We're just doing the B minus C. The A is 15%. So we're just going to add up all the tax credits now. So let's add up all the tax credits. So do that over here. Oh. So the base amount is 89,762. And once again, we're going to multiply that by 15%. And so that's going to give us basically 13,464. And so we minus that from our federal tax amount above. And so the federal tax payable after our non-refundable tax credits going to be 11,742. So this is sort of a typical problem that you may see on the midterm, not specifically these tax credits, but given sort of an income amount, figure out the federal tax payable before tax credits, figure out all the tax credits, and then figure out the federal tax after the tax credits. So similar type of setup for perhaps one of the problems on the midterm. Once again, not necessarily these tax credits, but using the tax credits that we covered last week, this week, and a different type of scenario, but this sort of structure. Any questions before we move on to the next problem?
Hey, Ronald. So just on the midterm there, you'd mentioned to skim the textbook to see if there's additional tax credits to look for. Most of the things we're going to see probably just from the tax table and just knowing how to do it, or should we probably also expect
Yeah, most of them will be on the rates table, but there are some additional information that you may need to sort of verify using reading the textbook. So for example, the home accessibility, the medical expense tax credit, what we just talked about that wheelchair ramp. If you didn't read the textbook, then you probably wouldn't know that you could claim it under both. So, I still say that the problems will be very similar to sort of the concepts that we discussed in class, and the majority of the tax credits will be the ones we've sort of seen and gone through. But there could be sort of the odd multiple choice question where we may not have gone through it in class, just to make sure that students read the textbook. But that would sort of be one of maybe the few multiple choice questions. But in terms of the tax credits, I would probably say, the huge majority of them we would have covered in class. Does that answer your question?
Yeah, thank you. Yeah.
So let's then move on to.
Sorry,
go ahead.
One last question. Sorry, I just got a little bit lost. When we're doing the C, it says factor of 3% of 132,400. Where did that 2001 came from? I got lost of why we used the 2759 instead of the 3972.
Oh, the 2759, that's sort of a given number. So this is a given number here.
Oh, I see up there. Okay, yes.
Yeah. So that's sort of given. That changes every year based on its index to inflation. Let me just sort of quickly look at we bring up the rates table once again here. This is sort of a good question to ask, because sometimes, you think it makes sense, then you go and study. It's like, where did that number come from? But let me just bring up the rates table. So these income amounts. So you see these amounts here, the 55,867, the 111,000.
Yeah.
Because of inflation, those amounts are going to be sort of increasing every year. So next year, you probably won't get the 20.5% until you're like maybe 56 7,000, 58,000. So these amounts are sort of always indexed to inflation, and that's sort of what it says here, that the index rate for 2024 was 4.7% because inflation was relatively high. Next year, 2025, the BPA amount might be 16,000 and something because of inflation. With the medical expenses, B minus C. C is the lesser of 3% of your net income and 2,759. So this amount is given by the government every year. And next year it might be a little bit higher because of inflation. So that particular 2,759 is set by the government. Does that answer your question, Erin?
Yes,
Yeah.
totally. Thank you.
Yeah, you're welcome. Any other questions before we continue on? So what we're going to do next then is this rather long problem here. And so hopefully you had a chance to read it. As I mentioned last week, it is a fairly long problem. And this is going to be a comprehensive problem that covers both chapters 3 and 4. Now, you're not going to see anything as large as this for one problem. The problems on the midterm will be, parts, maybe a part of this type of question, but it's not going to be the entire thing. But the reason I chose this problem is because it does bring together a lot of what we covered in chapter 3 and chapter 4. And once again, it does introduce some new concepts that we haven't yet covered. Again, illustrating the fact that the textbook does include so many little topics that I would encourage you to sort of read the textbook just so that you know where it is, because it is going to be an open book exam. So if you know sort of where that discussion about maybe extended health plan payments were, then you can just quickly look that up if there was, let's say, a small multiple choice question that dealt with that, but as an example. So this one here, if we just quickly go to the required, what does the required say? So one of the things is always think about what is the required, and that will sort of frame what you need to calculate to get to the required. We need to calculate Tanya's taxable income and also her federal income tax payable, and that would be the amount after tax credits. Now, one thing that isn't really mentioned in the required is that in order to calculate taxable income, we're going to have to calculate her net employment income. So this is going to bring in a lot about what we learned in chapter 3 about how you might have taxable benefits, like that automobile standby charge, maybe those stock option benefits. So it's going to bring together a lot of what we learned in chapter 3 about employment income. Also going to bring in some things that we haven't learned yet about chapter 3. And then once we calculate her taxable income, then we can calculate her federal tax payable, and then all those non-refundable tax credits. So what I've done is I've sort of set it up. Here, this is her taxable income. Now, once again, in order to calculate taxable income, we first have to calculate net income for tax purposes. Net income for tax purposes is 3A plus 3B minus 3C minus 3D. And included in 3A is her net employment income. That is all chapter 3. After we figure out net income and taxable income, then we can calculate the federal tax before tax credits, then all the non-refundable tax credits, and then what will be her federal tax payable after tax credits. So a fairly long problem, but once again, really good practice doing some review, but also introducing some new concepts. So what we're going to do then, and this is pretty good practice for those of you that are planning to, let's say, do your CPA or CFP. When you get to sort of those professional exams, you're going to be given sort of a big comprehensive question, and then you're going to have to sort of lay out sort of your template. And so what I've laid out here is sort of the template to work with. And so that way, as we're reading the question, we can just throw things into the template where they belong, so that it's just going to make things easier once we get to the end of reading the question. So let's just start off with the very first paragraph. Tanya's 46 years old. She's in good health. She works for a large publicly traded corporation that has gross revenues of $722 million. So one thing I always tell sort of students that are, entering their third and fourth year, when you're reading a question, always sort of pay attention to the facts that are given to you so that once again, you can tie it into where it needs to go on your template, but also it might help solve some of the calculations later on as well. So we have this large publicly traded corporation that is her employer. And that corporation, her employer, has gross revenues of 722 million. So obviously I've gone through the question, but if you're sort of thinking about where that might be applicable, it might be applicable when it comes to stock options. Remember when we went through stock options, we said that if it was your employer was a CCPC, you don't have to include that employment income benefit until you sell the shares. And then we talked about those new rules that came into effect, I think in 2021, where if it was a non-CCPC with gross revenues over 500 million, then you would have some stock options that are considered qualifying and others that may not be qualifying. So that's sort of what I mean by picking up on these key facts when you're reading the question, so that if there is a stock option component, this will sort of help guide our analysis and calculations. Let's go to item number 1. She's divorced. So basically she has no spouse and she has custody of their 11-year-old daughter. The daughter is disabled, qualifies for the disability tax credit, and the daughter's income for 2024 was $6,425. So automatically sort of ties into what we talked about. The daughter qualifies for the disability tax credit. She is 11, so she qualifies for the supplement as well. But she's not going to need the disability tax credit because her income is so low. Her income is $6,425. The daughter will get the BPA amount, which is 15,705 times 15%. That's going to offset all of the daughter's income. So the daughter can transfer the disability tax credit along with the supplement to the mother, Tanya, as well. And so once we sort of have that information, we can go quickly to our non-refundable tax credits and start putting that down so we don't forget. Now, before we record the transfer of the supplement and the disability, let's just say that, let's just get the easy one out of the way, the BPA. Everyone gets the BPA, 15,705. Now, it could be reduced. We don't know that yet because we don't know her net income, but let's just sort of put the BPA one down so we don't forget it. We know that she's going to get the transfer of the disability and also the transfer of the supplement. So those two are set, the 9,872 and the 5,758. So those are the ones we just saw in the previous question with Clarice and the 13-year-old child. Similar to what we saw with Clarice and the 13-year-old child, Tanya's child is 11 years old. And so once again, thinking about what we did with the previous problem, remember that candidate caregiver for child under 18, we can claim that as well. But before we do that, I want to just sort of read through the next paragraph. Let's just sort of read through the next paragraph as well. Tanya's 68-year-old mother also lives with Cynthia. Cynthia lives with Tanya. Rose is the mother's name, and Rose sort of provides care for Cynthia, the daughter that is disabled. Rose is active and healthy, and Rose's income is $13,460. So Tanya is supporting the daughter, Cynthia, who's 11 years old, and Tanya is also supporting the mother. The mother lives with them. And Tanya is divorced. So Tanya does not qualify for the spousal tax credit because Tanya is not married and is not in a common law relationship. So remember we said that if you are not in a spousal or common law relationship, you don't qualify for the spousal tax credit. But what you can claim instead is the eligible dependent. But you can only claim one. You can only claim one dependent using the eligible dependent. So then the question is, do we claim Cynthia or Rose, the mother? The eligible dependent also has that income threshold where we take the BP amount minus the dependent's income. So if you think about it, which one has the lower income? Well, Cynthia does, right? 6,425 versus Rose, which is 13,460. So because Tanya can only make one claim for the eligible dependent, she'd be better off claiming her daughter Cynthia because Cynthia has less income. So let's just sort of get this down on paper. So we have the eligible dependent, and this is for Cynthia. So once again, we use the BP amount minus Cynthia's income, 6,425, and that's going to give us 9,280. Now remember, Cynthia, the daughter, has a disability, also qualifies for that Canada Caregiver for child under 18. There's this sort of one where, remember with eligible dependent, we could add the caregiver amount here because Cynthia has an infirmity. Remember we said if you meet the definition of disability, you also meet the lower threshold of infirmity. And that caregiver amount was 2,616. But the way that sort of the legislation reads is that if you're claiming eligible dependent for a child under 18, which Cynthia is, and that child has an infirmity, which she does, then rather than add the caregiver amount to the eligible dependent, you claim it separately for the Canada Caregiver under 18. It's the same amount, it's 2,616. But the way the legislation reads is that you don't claim it by adding it to the eligible dependent, you claim it separately. I wanted to sort of show you it on the rates table just so you can see where these amounts are coming from. So once again, we go back to page 1. So we have the eligible dependent right here, 15% of the BP amount. And then if that dependent has an infirmity, we add the 2,616. But then for the Canada Caregiver for child under 18, is also 2,616. So once again, because this is for a child under 18 that has an infirmity, and because Tanya qualifies to claim the eligible dependent, we claim the eligible dependent the 15,705, and then for the infirm amount, we'll claim that under the Canada Caregiver for child under 18. So once again, just the way the legislation reads, if you were to have claimed it by adding the 2,616 to the eligible dependent amount, I mean, you're going to end up with the same amount anyway. So the CRA is not going to probably deny it because, you know, you can claim it under the Canada Caregiver for child under 18. But just the way the legislation reads, you claim the infirm amount using the caregiver for child under 18 instead of adding it to the eligible dependent. Any questions about those amounts? So then let's go back to the question and let's have a read. So because Rose is healthy, we can't claim that Canada Caregiver for infant dependents that were over 17. Remember, for infant dependents that are adults that you're caring for, they have to have an infirmity. Rose is healthy, so doesn't qualify for that. Then we move on to the third item here. So let's go to item number 3. Because of Cynthia's mobility decline, Tanya had to install several access ramps in her home and the cost of the ramps was 14,600. So once again, similar to the question that we just did. So if you read that in the question, you think automatically that qualifies for the home accessibility, but that amount can also be added for medical expenses. So let's just sort of make a note of the home accessibility tax credit. And once again, lesser of 20,000 and 14,600. We'll also just sort of make a note here, also qualifies as medical expense as well. So just sort of make a little note there. So when we get to the medical expenses, we'll remember to add that amount. So number 4, Tanya worked nearly 300 hours as a volunteer search and rescue volunteer, for which she received $200 in compensation. So this is sort of one of those tax credits that you're probably not going to see that often. Even if you were, let's say, doing a lot of tax returns, this is only available for someone who volunteers as, let's say, a community firefighter or as a search and rescue volunteer. So just looking at the question in the chat, does it matter which dependent you claim for if you can claim home accessibility and medical expenses? So it has to be a dependent. So it has to be somebody that Tanya is, supporting. So if it was the Cynthia, the home accessibility, it could even have been, let's say, for the mother as well. The mother, let's say, had some mobility issues and they had to install, once again, some ramps for the mother, that would qualify. And then they had to install additional accessibility for Cynthia, the daughter, that would qualify as well. So it's not limited just to one individual. If Tanya was doing home accessibility modifications for both the mother and the daughter who Tanya was supporting, then she could claim all of those amounts under home accessibility. But once again, limit it to 20,000. Does that answer your question, Hayden? Perfect, okay. So let's talk about volunteer search and rescue. So one of these tax credits that you don't see often, even if you're doing a lot of tax returns in real life. So here we go. Volunteer firefighter and volunteer search and rescue. You can only claim one. If you were providing both firefighter volunteer and you were also volunteering for search and rescue, you can only take the credit that corresponds to your primary service. So the one that you spend more time volunteering, you can't claim it twice if you were doing volunteer firefighter and search and rescue. Now, what it also says is that you also have to sort of include any sort of compensation that you can receive. But what it says is that if you want to exempt from any income up to $1,000 in compensation that you receive, let's say from the fire hall that you volunteer at, then you cannot claim the tax credit. So what it's saying is that you can't have the best of both worlds. If you get some sort of stipend for covering some costs, $300 or $400, then you have to include that in income if you want to claim the tax credit. If you don't want to claim the tax credit, then you can exclude up to $1,000 that you get in compensation. Now, in this example, the amount that Tanya receives is relatively small. She's only going to get $200 in compensation. And then the question is, well, how much is the tax credit? And so we go to the rates table. I'll show you where it is on the rates table. Scroll to the next page. The second one from the bottom, volunteer search and rescue, right above that is volunteer firefighter. But once again, you can't claim both. And once again, she only volunteered for search and rescue. So that's the only one she would qualify for. But basically it's $3,000. So 15% of $3,000. So she's better off claiming the tax credit because 3,000 times 15%. So we go 3,000 times 15%, that will reduce her taxes payable by $450. And yes, she has to include the $200 in income, but even if she's taxed at, let's say, 26%, she's going to have a greater reduction. 3,000 times 15% will reduce her taxes by $450. And that's going to be a far greater reduction than the taxes she will pay on the $200 she has to include in income. So that's sort of where the tax credit is on your rates table. So we go back to our handout. There's a couple things we have to do. We have to add that volunteer search and rescue compensation of $200 to her income. And so we go to her other amounts here. We'll put the volunteer compensation, and that was for $200. And then under the tax credits, search and rescue, and once again, that was $3,000. So once again, a lot of these tax credits are not that common. And so that's why I really encourage you to sort of just read your textbook, just so you're familiar with sort of how they operate in case they do come up on the midterm next week. Let's continue on to the next part. We have her medical expenses. So if we look at these expenses here, we're kind of separated between Tanya and Cynthia and the mother. Remember, we said that the B amount would be for Tanya and her children under 18. Tanya doesn't have a spouse, so the B amount would just be for Tanya and Cynthia. And then the D amount is E minus F. And so the E amount would be the medical expenses for the dependents that Tanya is paying their medical expenses where they are over 17 years of age. So we just sort of quickly scan these ones. Prescription drugs, those are fine. Medical specialists, those are fine. Now, when it comes to sunglasses, as long as they're prescription, they do qualify. So if they were not prescription, they would not qualify. But because they are prescription, they do qualify. And then we get cosmetic surgery for Tanya. And so once again, remember we said anything that's cosmetic in nature does not qualify. So these are the amounts that would qualify for the B amount. And because Tanya is paying for her mother as well, the dentist and the dentures, those would qualify for under D, the separate calculation. D is equal to E minus F. We'll go through that in detail. But let's just sort of summarize these amounts so we don't lose them. So under our tax credits here, let's just sort of create a space for medical. Actually, can we do it over here? Actually, let's do it over here. Let's just sort of do it over here. So B would be, what are those amounts again? 3,465, 10,490, and 875, 14,830. But then remember, we also had the ramps that were installed as well. And that was the 14,600. So let's just sort of do the B amount first. So the B amount, 14,600 plus the 3,465 plus the 10,490 plus the 875. And so that's going to give us 29,400. And then D equals E minus F. And once again, this is all for the mother. And so the E amount is the medical expenses for the mother that, once again, Tanya paid for. And so that's going to be the 3,300 and the 1,325. And so 4,625. Now we'll come back and sort of finish these calculations later, because remember, for the C amount, we need the lesser of 3% of Tanya's net income. And once again, we don't know her net income yet. So we can't figure that out. And remember that second amount was given to us, which was 2,759. The interesting thing about the F amount down here, this is calculated the same way as the C amount. So if we calculate the F amount down here, but this is the lesser of 3%. Oops. Hold on here. It's not of Tanya's net income, it's of the mother's net income. Oh, hold on here, what's going on? Now, the mother's net income was given to us. If you remember back in I think it was item number 2 or 3, the mother's net income was given to us 13,460. And so 3% of that's going to be 404. And the second amount is also the stated amount, the 2,759. So we'll come back and finish this because the one thing that we're still missing is we haven't calculated Tanya's net income yet. But that's sort of how it works. B minus C is for B would be the taxpayer, the spouse, and children under 18. D is for any medical expenses the taxpayer pays for dependents that are over 17, in this case, the mother. D is equal to E minus F. E is just the medical expenses for that dependent over 17, which is the mother. And then F is the lesser of 3% of the mother's net income and the 2,759. So we'll come back to this once we know what Tanya's net income is. And once again, clean that up a bit. And so going back to the question, we've dealt with the medical expenses. And then item number 6 is her charitable contributions to a charity for 3,500. Now that qualifies for a tax credit, but if you remember from last week, we have to do a separate calculation. So we go back to our tax credits. We know that all these amounts, including the medical, will be at 15%. But the charitable donations is going to be a separate calculation because some will be at 15%. Remember the first 200? Some might be at 29, some could be at 33. But we know that the total charitable donations are 3,500. So we'll put that number there so we don't forget to calculate it when we figure out what her income is. Because remember, if some of her income is going to be taxed at 33%, then some of the donations will get a tax credit of 33%. We don't know that yet, so we'll leave that number there for now. So we've done everything on the first part, all her personal information. What we're going to do next then is focus on chapter 3, her employment income. So item number 1 under employment information, her salary, 93,500 for 2024. Once again, we're looking at the 2024 year. She was also awarded a year-end bonus, which will be payable in January. If you remember when we started off chapter 3, we said that if the company declares a bonus this year in this company's, fiscal year, but they don't pay it right away, as long as they pay it within 179 days of their fiscal year end, then the recipient, the employee, doesn't have to include that in their employment income until the year they receive it. Remember, we looked at those 4 sort of executives, that one example. So in this example, she has to include the 93,500, but the $12,000 for the bonus, because it's not payable until next month, January, that's within 179 days of the company's year end, that will not have to be included in Tanya's employment income until 2025. So under her net employment income, we'll just put the salary amount down now. $93,500. Bonus will be included next year. Let's continue on with employment information. Tanya's employer sponsors a pension plan, which is an RPP, registered pension plan. In 2024, Tanya and her employer each contributed $4,150 to the plan. And we kind of talked about this when we started Chapter 3 employment income a couple of weeks ago. We said the Canadian government is trying to encourage Canadians to save for retirement. So if you open up your own RRSP and you put money into your own RRSP, you get a 3C deduction. That's going to reduce your net income. An RPP is one that's set up by your company. If you put money into an RPP, which Tanya did, that is going to be a deduction from her employment income, trying to, again, encourage employees to start saving for retirement. So the money that she put in to her plan will be a deduction from employment income. And we said that the amount that her employer puts in, even though it's added value to her pension plan, again, the government is trying to encourage Canadians and the companies they work for to help their employees save for retirement. That 4150 will not be a taxable benefit. So even though her employer put in a separate 4150 into this pension plan for Tanya, that will not be a taxable benefit to her. But she will get the deduction for the amount that she put in. So under her net employment income, RPP contribution, this is the amount that Tanya put in. That will reduce her net employment income by $4,150. And once again, as we're going through this, if you have any questions, feel free to just unmute and ask your question or type it into the chat. Back to employment income or employment information, item number 2. In addition, her employer withheld maximum EI and CPP. So the EI will all be a tax credit. The CPP maximum 4056. Once again, if you're unsure what to do, go to your rates table, find the CPP amount, and the maximum for CPP is what was it again? 4056. And remember, we said that with this amount, part of it will qualify for a tax credit. The tax credit will be 3218, and then the difference, 838, will be a deduction when calculating net income. So we've got to deduct the 838 when we calculate net income, but then the tax credit amount will be 3218. The EI amount will be 1,049. And then once again, because she has employment income, she will also qualify for the Canada employment amount, which is 1,433. So a lot of information there, but let's go back to our Excel document. So other amounts, remember we're calculating up here net income for tax purposes. So that's CPP deduction of 838. No, sorry, 838. And then we go down to her non-refundable tax credits. We have EI, CPP, and Canada employment. So maximum EI was 1,049. The maximum tax credit for CPP, the 3218, and then Canada employment 1,433. And once again, it's just because she has employment income. If this was non-employment income, then of course there would be no EI CPP amounts. But it's clearly stated that this is employment income, and we're told that the employer withheld maximum EI CPP. Let's move on to item number 3. She's taking an intensive course in spoken Chinese at a university. The course is a personal interest and it's not related to her employment. And the tuition fee is all paid by her employer. So this sort of gets to, once again, is this a taxable benefit or not? And once again, we didn't cover it when we went through chapter 3, but what I did here was I cut this out from the chapter 3 textbook, page 131, 132, education related benefits. So if the employer pays for the employee's children's education, that is included in the employee's income. That's a taxable benefit. If the employer pays for a course that is directly related to the employee's employment, that is not a taxable benefit. So, for example, if you end up graduating and let's say you are studying for your CPA or CFP and you're working for a bank doing your CFP, you're working for a CPA firm doing your CPA, and they pay for all your tuition for your courses. That is directly related to your employment. And so that is not a taxable benefit. Now, if the course is related to the general business of the employer, it is also not considered a taxable benefit. So let's say you're working in a CPA firm, but let's say you're just starting off as maybe a receptionist. So you're just starting off as a receptionist, but you tell your employer, I want to eventually, start moving up in the company. So can I just sort of take some general business courses and then eventually get my BBA and then pursue my CPA designation? And so that could be a situation where, those business courses may not be directly related to the CPA's business, but is related to sort of the general business. It's still operating as a business. And so, business courses would be related to the operations of the CPA firm. So once again, that tuition that's paid by the employer for, let's say, that receptionist that's taking these business courses, you could argue that that is, related to the general business of the company. And so that would also not be considered a taxable benefit. And then we sort of talk about what if it's just for personal interest? If the course is just for personal interest of the employee, then it is considered a taxable benefit. So that's sort of where we're falling in with this question, is that this language course that Tanya has taken is purely for personal interest, not related to employment. So that would be a taxable benefit. So we would have to include that in her net employment income. So that 3,600. The tuition paid by employer, once again, just personal interest, that would be added to her employment income, 3,600. Now this is tied to a tax credit that we haven't talked about yet. Because she is going to be taxed on this amount, 3,600, she can claim that tuition as a tuition tax credit. And so once again, we didn't talk about it in detail, but once again, talked about a little in your textbook, also on your rates table as well. If she did not have to include this amount in her employment income, then she could not use it as a tuition tax credit. But because she's included it in her income and she's going to have to pay tax on it, she is able to claim a tax credit related to that tuition. So under the tax credits, we can also add 3,600. Any questions about the tuition? So let's move on to item number 4. Tanya is provided with disability insurance by an employer-sponsored plan. So disability insurance A lot of companies provide that for their employees. So if the employee gets disabled and cannot go to work, then the disability insurance will kick in. The employee, while they're not working, will not get a salary, but they'll get payments from this insurance company to sort of cover, not necessarily be all of their lost wages, but maybe a good portion of that. So the disability insurance is provided by the company. And in 2024, Tanya got into an accident and she was unable to go to work. And so she received disability payment of $6,500. Now, when the plan started, Tanya also had to make some payments as well. So even though this is a company-sponsored disability plan, usually what will happen is some of the benefits may be optional. So when you work for a company, you may have a choice as to certain benefits that you can sign on to or decline. And if you sign on to certain benefits, then you may have to pay part of those premiums as well. So in this example, Tanya also had to pay $340 a year for this disability insurance coverage. And once again, her employer paid the remainder, which was equal to $340 a year as well. So both Tanya paid $340 and her employer paid $340 each year starting in 2022 for this disability insurance. So this is one of those things where unless you sort of read the textbook, you're not going to really know what to do. So they talk about 3 possible situations when it comes to disability plans that employees qualify for through their employer. And the 3 possible situations is that the employee could pay the entire premium, or the employer could pay some, and then we have these 2 here. So kind of confusing, but the text sort of makes it easier. They tell us that the most common types is the last one. So this is sort of the most common type of plan that you're going to see in the majority of disability plans that companies offer their employees. And this is one where the employer makes regular contributions that do not create a taxable benefit for the employee. So what we're saying is that this plan, the employer pays $340 a year, and Tanya also pays $340 a year. And in this plan that is most commonly seen in real life, in this type of plan, the $340 that the employer pays is not a taxable benefit. So even though the employer is covering some of the premiums for the disability insurance that Tanya could benefit from, because it falls into this most common type of plan here, the premiums that the employer pays on behalf of the employee does not create a taxable benefit. So they do not create a taxable benefit. However, if the employee receives any disability amounts, that will be included in the employee's income. So if the employee never goes on disability, then the amount that the employer pays as a premium is not a taxable benefit, but at least they're covered. But once the employee goes on disability and receives disability payments, they have to include that amount in income. And the very last sentence, most of our examples and problems will be based on this type of situation. So we're just going to assume that, unless we're told otherwise, this is the type of plan that these problems relate to. What happens then is the employer's contribution do not create a taxable benefit. We talked about that. If the employee receives disability amount, the employee's contributions made in that year and preceding years can be deductible against the disability amounts they receive. So Tanya is paying a certain amount every year. The amount that she pays will only come into play if she receives disability payments, if she goes on disability and receives payment. If she does, she has to include that amount in income, the amount that she receives at disability payments, but then she gets to deduct all the premiums that she's paid in the current year and also in the past years as well. So let's just sort of look at that with respect to these amounts. She receives 6,500. That has to be included, and it has to be included in her employment income because this is replacing her employment income. She's not able to work, so this is replacing her employment income. So that will be included in her net employment income calculation. But she gets to deduct $340 per year for 2022, 2023, and also 2024. So she's paid it for 3 years, including the year that she received the disability payment. So she can deduct that from the 6,500. So how would that sort of look like? Let's just sort of go back up to our net employment income. And so she's going to get the disability payments. Of 6,500, but then it can be reduced by the 3 years that she's paying $340 per year. So what would that be? That would be 1,020. And so the net amount that would be included would be 5,480. So again, that's the thing about taxes, that it's a lot of information. And so once again, these sort of situations where someone goes on disability may not happen that frequently, but sort of when it does, at least you sort of know where to look to find out what the tax rule says to sort of make sure that you account for it properly. Any questions about the disability payments received?
Hey, Ronald, in
Mhm.
this type of situation, would you ever have to like deduct a month of their regular income salary off of it? Or is it just assume that their salary remains constant and then you just use the disability?
So we're assuming that on the period that they're getting disability, they're not getting paid.
Okay, so then would we have to reduce the 93,500 just divide it by 12 and take a month off?
So the 93,500, we're just, I see what you're saying, but we're just assuming that that is just the salary. Where is it here? That's just what she received. And it does not include the time that she was not working.
Okay,
Yeah,
thanks.
so we assume that that's already taken care of, that the 93,500 was for the time that she was working. The time that she was not working, she did not get paid. That 93,500 is only for the time she was working. But that's a good point though. So let's continue on with the next part, item number 5. Item number 5, her employer provides her with an automobile. So once again, okay, standby charge. The cost was 39,500. During the year, 41,000 total kilometers driven, 34,000 were for employment, 7,000 for personal use. And Tanya is required to pay all of the operating expenses herself, which was 7,240. The car was made available except for 1 month for the year. That was the 1 month she was off work. Remember, she was on disability. And during the 1 month that she was not using the car, it had to be left in her employer's garage as required by her employer's policy. So we know that we have to calculate some sort of standby charge. So we know that there's going to be some sort of standby charge that we have to include here. And if you remember from your chapter 3 discussion, I don't have the textbook open, but I believe it was page 149. So if you have your e-textbook or your textbook in front of you, I believe the formulas were on page 149. Actually, let me just see if I can quickly look at the e-textbook and confirm that. Yeah, page 149. And so if you remember from chapter 3, we said that the standby charge formula, you need to figure out whether the car was owned or leased. This one, it was owned. So we look at the formula where it was owned, we had 2% times the cost of the automobile, 39,500. And then remember we said we times it by days available, divide it by, days available divided by 30. That's what the formula says. But remember we said that basically it's just the number of months, right? So if you were given the days, let's say the days available were, let's say 93, you would just take 93 divided by 30, and then you would round it to 3. So round it to the nearest month, it would be 3 months. But in this case, we're given the number of months. It was available all except for 1 month. So it'd be 2% times 39,500 times 11 months. And that would be 8,690. And once again, this is the full standby charge. And then we also said that a reduction might be available if it was used more than 50% of the time for employment use. And so we're given the number of kilometers that was driven for employment use, 34,000, divided by total 41,000. And so that's going to be about 83% for employment use. So we know that she will qualify for the reduction. And remember we said the reduction, basically we just take the 8,690, the full standby charge, and then we multiply it by the number of personal kilometers. So 7,000 personal kilometers, divide by, and once again, this is given in the formula. This number is given in the formula, 1,667 times months of availability, 11 months. So that way you be your denominator. So essentially what you get is 8,690 times the fraction of 7,000 over 1,667 times 11. And when you work through the math, your reduced standby charge is going to be 3,317. So I'll just sort of let you just sort of work through the calculation quickly just to make sure you get the same calculation. But once again, this is all from page 149, which we covered in detail in chapter 3. So the standby charge is going to be reduced. So the amount that gets added as a taxable benefit is 3,317. Questions about the standby charge? Now, the examples that we did in chapter 3, there was the operating cost benefit as well. The operating cost benefit is basically saying that there's going to be operating costs associated with using this car. Gas, repairs and maintenance. In the examples we looked at a couple weeks ago, all the operating costs were paid by the company. In this example, if we go back to the question here, all the operating costs are paid by Tanya, and they totaled 7,240. So in the textbook, I've sort of made some notes right down here from the textbook, page 147, operating cost benefit. The operating cost benefit applies if the following conditions are met. A standby charge has been applied to the individual. So in Tanya's case, yes, we had to apply the standby charge. The employer has paid for the operating expenses, and part of the expenses relate to personal use. This one condition is not met because the employer did not pay for the operating expenses, Tanya did. So in this case, the operating cost benefit would not apply because the employer did not pay for the operating expenses, Tanya did. So there will be no operating cost benefit in this case. Any questions about that? Now, if you think about it, Tanya is using the car mostly for work, and she is paying for all the operating cost herself. So of that 7,240, some of that should be deductible when calculating her employment income because she's paying for all the operating costs herself. We talked a little bit about that last week. Remember we talked about H and H.1, and we said H.1 includes all of those motor vehicle expenses. And generally speaking, that would include gas, oil, operating expenses. So in this example here, we're not specifically told that the employer has that sign T2200. Remember we talked about the fact that in order to deduct certain employment expenses, you need the employer to sign the form T2200. That's not specifically stated in this question, but one could assume that because she's paying for all these expenses and she needs the car for work, that form would have been signed. Otherwise, why would you bother incurring all these expenses if you weren't able to make any of the deductions? Why would you pay for all those operating costs if you weren't able to deduct any of it? So we can just sort of assume logically that form T2200 would have been signed by the employer. And then now we got to think about a logical way of how much of the 7,240 relates to employment use. Well, the most logical way is just to prorate it. A total of 41,000 kilometers driven.
Hi, Ronald. Sorry.
34,000. Mhm,
Just a question about the operating expenses of the vehicle. What
mhm.
if part of it is paid by the employer and part of it's paid by the employee?
Okay, so then what we would do then, remember a couple weeks ago, we said that you would calculate the operating cost benefit, and then you would deduct the amount that the employee, let's say, reimbursed to the employer. That would be the amount that the employee paid. Then you would sort of do it that way. So
Okay.
you would calculate the operating cost benefit just like we did using those examples we did a couple of weeks ago. And then remember, if you remember, I said you less the amount that the employee reimbursed the company. That would be the amount that the employee paid. So you would still calculate the operating cost benefit minus the amount that the employee paid.
Okay, sounds good.
Yeah,
Thanks.
yeah. No, that's a good question. That's sort of why I put that line back in chapter 3 when we did those operating cost benefit minus the amount that the employee reimbursed the company, because they would get credit for that. But in this situation again, because everything was paid by Tanya, and because the car was used mostly for work, she can deduct some of the 7,240, once again, assuming that T2200 was signed. And then all we're going to do is just figure out the amount that she can deduct by taking 34,000, which is the employment kilometers, dividing by the total kilometers, 41,000. So the deductible car operating expenses, that would be, once again, under H.1, H.1. We're going to assuming that T2200 was signed. So what we're going to do is just take the 7,240 and then just prorate it based on the employment kilometers divided by the total kilometers. And once again, this is going to be an expense, right? So once again, let's make sure that we put a minus sign because this is an expense that she's paid. And she's going to be able to deduct that from her employment income. Any questions about that amount? So it kind of ties to what we did last week at the very beginning of last week's class. What I want to do then, I'm going to just keep on continuing with the question rather than take a break, because I think it's sort of easier rather than take a break and then trying to figure out where we left off. We'll just sort of kind of continue on because we're probably, close to maybe probably be done by about 8 o'clock today. So why don't we just continue on rather than take a break, just so that we have that continuity with the question. let's go on to the next item. Item number 6. Tanya's employer provides all of its employees with financial counseling services. The cost to the company of the services provided to Tanya was $450. So some employers provide different, again, benefits to their employees. One of the benefits that Tanya gets is to help with financial counseling. So maybe to help with maybe debt management, maybe, sort of budgeting. And so the benefit that she received this year was $450. And once again, Chapter 3, is that a taxable benefit or not? And so once again, cut and paste this from your textbook, page 129. So page 129 again from Chapter 3. These are things that are excluded from employment income. And once again, employers' contributions to RPPs. We talked about that. If you are an employee, you belong to a company pension plan, an RPP, the amount that your employer contributes is not a taxable benefit. So it's excluded from employment income. We talked about that at the beginning of this question. What about counseling? So if the counseling is with respect to mental and physical health, excluded, not a taxable benefit. If it's related to re-employment or retirement counseling, excluded, not a taxable benefit. So this one is a little bit tricky. It's not related to re-employment. Re-employment would be, let's say the company was downsizing, and so they had to lay off some employees. And so as part of the severance package, they gave them some employment counseling. That would not be a taxable benefit. So this is clearly not re-employment. But then the question is this retirement? And I can sort of see how some students might assume that, okay, financial counseling, it could relate to retirement, but because it doesn't specifically say retirement counseling, it just says financial, where is it here? Financial counseling services. It's not explicit that it relates to retirement. So the question sort of assumes that it's not retirement counseling. So then this would be a taxable benefit. So if it was retirement counseling, it would be excluded from employment income. But because this is not related to retirement counseling, this would be a taxable benefit. So under our employment income, the financial counseling, we would add the 450 because that's a benefit that would be added to our income subject to tax. Moving on to number 7. As a result of winning a sales contest, Tanya gets a 1-week vacation to Las Vegas, and the value was $5,620. Now, this sort of related to what we talked about in Chapter 3, so 2 weeks ago. We talked about rewards, awards, long-term service, and we said that, yes, there's that $500 sort of non-cash award limit that would not be subject to tax. But we also said in that discussion that anything that is performance related is included regardless of whether it's cash or not cash. And so she won a sales contest, meaning that she was the top salesperson. So it's performance related. So that's sort of the key here. She won some sort of sales contest because she was probably the top salesperson or hit sort of a certain number of sales for a particular period of time. Because it was performance related, even though this is non-cash, the full amount is a taxable benefit. So because it's performance related, the full amount is a taxable benefit. So that 5,620 value of the trip would have to be added to her employment income. So performance related award, the full amount, 5,620, is included in her employment income. Now we just have one more item to look at, and this relates to stock options. So a couple years ago, she was given option to buy 250 shares at a price of $25. When the time the option was granted, the shares were trading also at 25. So remember we said that when the option is granted, there's no tax consequences, but you have to measure whether it's in the money or not in the money. And this is exactly the same value. So she's not going to be in the money, right? Because she's not going to be better off if she exercises the stock option. She can exercise it right away for 25, but she can only sell it for 25. So she's not making any money. So this is an example where she is not in the money. She would only be in the money if the fair market value was lower than 25, or sorry, was higher than 25. So the fair market value was higher than 25, then she could, let's say the fair market value was $30, she could buy the shares right away for 25, sell them that same day, and make a $5 gain per share. So then she would be in the money. But when it's exactly the same price, she can't make a gain by buying it and then selling it on that same day for that 25. So then she is considered not in the money. And once again, why is that relevant? Because if you're not in the money, you do get that 50% stock option deduction. But the one thing that we said at the very beginning of this question was that this is a public company. And the gross revenues are 722 million. And if you remember from when we went through stock options a couple of weeks ago, we talked about the fact that if the company giving you the stock option was not a CCPC and their gross revenues were over 500 million, which this one is, we have to figure out whether there are a certain number of shares that are qualifying and a certain number that are not qualifying based on that $200,000 amount per employer per year. So let's just sort of quickly review that and see how that applies to this particular stock option. So I'm just gonna, let's see, where are we here on the question? Question is up here. So let's just sort of do the stock option analysis here. So we said it's not in the money, but because it's a non-CCPC with gross revenues over 500 million, we have to figure out whether some are qualifying and if some are non-qualifying. And we said that basically the first 200,000 will be qualifying. So what does this 200,000 relate to? It relates to when the option was granted. So on the grant date, she was allowed to buy, is it 250? Let's see, 250 shares. And then we look at the fair market value. So this one is a little bit confusing because the exercise price is the same as the fair market value. Fair market value was 25. So we look at the fair market value on the grant date of these 250 shares. And we get a total value of 250 times 25, only 6,250. So that would be sort of the fair market value if she was to have exercised the option on the grant date. Because this is less than the 200,000 sort of annual amount that's given, so the 6,250 is less than the 200,000 annual limit. all of the 250 shares are qualifying. Meaning they qualify for the 50% deduction. So once again, we're going back a couple weeks, but that sort of ties to that discussion, that example we did with Manaz regarding the stock option issued by a CCPC, a non-CCPC, where the gross revenues are over 500 million. So in this case, even though it's a non-CCPC with gross revenues over 500 million, because the value is so low, it's below that $200,000 annual limit, all the shares will be qualifying if and when she exercises the stock option. Any questions about that? So then what happens in 2024? In 2024, she exercises all the options. On the exercise date, the shares are trading at $32, and she still owns all the shares at the end of the year. So now we got to figure out what is the amount that gets included in her employment income. And then what is the amount of deduction she gets to take when she calculates taxable income. So 250 shares times the difference between 32 and 25, that's going to be her net employment income amount that has to be included. So the stock option, 250 shares, the value per share on the date that the stock option was exercised is 32. She paid 25. So that kind of makes sense, right? She's basically ahead by $7 per share. And so times 250 shares, the benefit that she's getting is $1,750. So that's going to be added to her net employment income. So let's just we know that this is the last amount in the question. So her net employment income is basically going to be the total of all these amounts here. So where we left this here. So her net employment income is 103,563. But related to that stock option, she's going to get a deduction here when calculating taxable income. Remember, the option was issued not in the money, so she qualifies for the deduction, and she's going to get it on all the shares because she was below that 200,000 annual limit, because this was a non-CCPC with gross revenues over 500 million. So she's going to get the full 50% deduction. So that's going to be 50% times 1,750. And so that's going to reduce her, I'm going to put this in this column here. There'll be a deduction of 875. I'm just going to move these two amounts over to be in the same column. Any questions about the stock options? So just sort of be aware that this 1,750, this benefit increases her net employment income, which will also increase her net income for tax purposes. The deduction doesn't come until we calculate taxable income. So once again, the full amount added to employment income, which is included in net income for tax purposes, if they qualify for the deduction, it doesn't take place until you calculate taxable income. So now we can calculate net income. So I'm just going to highlight this. So this is just going to be her net employment income plus the volunteer compensation minus the CPP amount, 102,925. And then her taxable income will be $102,050. So now that we have her taxable income, we can now calculate her federal tax before tax credits. So let's actually move it over here. So once again, using your rates table, we now have the taxable income of $102,050. See if you can calculate the federal income tax, once again, using your rates table before tax credits. Once again, if you look at page 1 of your rates table, figure out which row you're in. We're going to be in the row where taxable income is over 55867. So when we're in that row, we take 8380. And then the amount over that will be at 20.5%. And that's just going to be the difference of 102,050 and the amount given in the question, 5586, or no, the amount given on the rates table. So let's just see what we get there. So I worked through that calculation, and the federal tax before tax credit, 17,000, rounded to the nearest dollar, 848. Any questions with that calculation? And now we have all our non-refundable tax credits. And the only one that we haven't calculated, well, there's two, the medical and also the donations. So remember the medical, we started the calculation over here. And the thing that we were missing was Tanya's net income. Well, now we know her net income. Her net income is 102,925. So remember, net income, not taxable income. And so if we work through that calculation, that's going to give us 3,088. So this was the part that we were missing. And so what we can do now is finish off this medical expense tax credit. So what is B? B is 29,430. What is C? The lesser is going to be 2,759. So B minus C plus D. Well, what is D? D is E minus F. This is E. What is F? F is the lesser of the two amounts. That's going to be 404. So let's just sort of type it in so we have it fully. So B minus C, so that's going to be 29,430 minus C, 2,759 plus D. D is E minus F. What is E? 4,625 minus F, 404. So the total amount is going to be 30,892. And remember, the A is just 15%, so we can just take that 30,892, add it to all of our base amounts, and then multiply all of our base amount total by 15%. So we're just going to transfer this amount, 30,892, over to our non-refundable tax credit base. Any questions before we transfer that number over about how we got the 30,892? Let's move over to our medical. 30,892. Now we still have to do the donations, so I haven't forgotten about the donations. I'm just going to bring all this up a bit since we have all this extra room here. So let's add up our base amount. So we'll just do a total here. So 101,023 times 15%. So that's going to be roughly 15,153. And then we have the donations. So remember the donations, the first 200 at 15%. And so that's going to be $30. B is not non-applicable. Because remember we said B is only applicable if your income, if you look at the donation tax credit on your rates table, B is only applicable if your income is over that 246,752. And so remember her taxable income is only $102,050. So B is not applicable. And so the remainder C will be the 3,500 minus the first 200. So then we have 3,300 times 29%. And so that's going to be $957. So the total donation tax credit will be $987. So this would actually be the total tax credits. So let me just sort of add these two together. So that would be the total tax credits, 16,140. That's the 15,153 plus the 987. I'm just going to move this one over then. Move this over here. And then the federal tax payable after tax credits, we're just going to take the 17,848 minus the 16,140. And so the federal tax payable after tax credits, 1,708. Any questions about any parts of these calculations that we've done? Once again, there's a lot of information that this particular question sort of encompassed. A lot from chapter 3, a lot of the topics that we did cover, but some topics we didn't. A lot of the tax credits that we covered, but a few that we didn't, the volunteer search and rescue. So once again, just sort of make sure that you focus first and foremost for the midterm on what we did cover in class, but also once again, make sure that you do read the textbook chapters just for those, those few maybe multiple choice questions that might cover something that was not covered in the Zoom lectures. I'm going to just sort of pause here for a second. Any questions about this problem or any questions about the midterm that you want to ask before you wrap up for today?
Realistically, how would a problem like this compare to a full problem on the midterm?
So as I sort of mentioned at the start of this problem, you're not going to get such a big problem like by itself. There might be sort of one component where you're asked to calculate all the tax credits for an individual. Maybe you're given the taxable income, and now you just have to calculate sort of this part here. So
Okay.
you're given, let's say, the taxable income, and then all you need to do is just sort of calculate this part here. Or maybe there would just be a question that focuses on employment income. So maybe you just have to sort of calculate, this part here.
Okay. So there won't be a whole comprehensive question relating to this.
Yeah, nothing to this degree, like nothing we're going to have to do all these calculations in one problem. And sort of if you look at the breakdown of the marks for the problems, that might give you sort of some idea. So I think I sort of talked about how the problems, what did I say on eLearn? Let me just sort of quickly bring up eLearn. Where's eLearn? So here is eLearn. Where's the midterm? Yeah, so down here, I said that there's going to be 13 multiple choice questions, followed by 3 problems, 12 marks. You said, I don't think, I didn't give you a breakdown of the problems, but, 12 marks each, 3 problems, so 3, 4, 5 marks per problem. So you're not going to get, once again, like a huge problem like the one we just did. But once again, there might be parts of that that will comprise one problem. So one of the problems, again, might just give you the taxable income. And then you have to just sort of finish the rest of the question by calculating the federal income tax given the taxable income, and then all the non-refundable tax credits. Or there might be a problem that focuses on just employment income. So there's some stock options, there's some automobile benefits. What's going to be the impact to net employment income? So that might be another problem, for example, but not one problem that encompasses everything that we did in assignment problem 4-5. Does that help answer your question?
Yeah, definitely. Thank you.
Yeah. Any other questions about the midterm?
Hey, Ronald, so it
Mhm.
says on for submitting it that you want calculations. So are we able to put screenshots in or Excel file, or what's your preference there?
So I think we talked a little bit about that last week. So there's going to be no attachments. You just have to sort of type it into the answer box in eLearn. But if you were using Excel, you could maybe like, so if let's say you were using Excel, then it asks for the standby chart. So you could probably like just sort of cut and paste those calculations onto the answer box in eLearn and do it that way. Sometimes when you cut and paste into the answer box into eLearn, the formatting may be a little bit off, but I wouldn't worry so much about that because usually as long as you have the calculations there, I can sort of make it up. Um, One thing that I sort of set up on eLearn is that I asked you to, for the problems to sort of put your final answers at the very top of the answer box. I kind of set up a template. So that way I know what your final answer is, and then your supporting calculations will be below that. So that way it's sort of easy for me to figure out what is your final answer and where your supporting calculations are. And that way, if you provide sufficient supporting calculations, I can always give you part marks if you didn't get the final answer right. But once again, no attachment. So if you were given, let's say, a question about non-refundable tax credits, not a lot of calculation, you just sort of list them out here like that. If you had to do some medical calculations, then once again, if you wanted to do it on Excel, you could just sort of list them out here like that and then cut and paste into eLearn. But no attachments are allowed on the exam. So either type it in directly, or if you want to use Excel, then just cut and paste from Excel into the eLearn answer box. Does that answer your question?
Yeah, that's all great. Thank you.
Yeah, yeah. Now, once again, with the midterm next week, make sure that you start on time because it is time limited to 120 minutes. So if you start at 6 o'clock, it will end at 8 o'clock. I did sort of leave a little bit of leeway. So let's say you start at, I think, 6:01, then you'll get until 8:01. But I didn't leave a lot of leeway. So that way, I think it's going to close at 8:05. So if you start at 6:05, you will get to 8:05. But if you start at 6:10, it will close at 8:05. So make sure that you start, between 6 and 6:05 p.m. But once again, if you start at 6, it will end at 8 o'clock, 120 minutes. And as I mentioned here on the screen here, I will be on Zoom for the first 10 minutes. So if you have any technical issues, just hop onto Zoom. We can try to figure it out. But there shouldn't be any technical issues. All the years that I've done eLearn exams online for online classes, there's never been any sort of technical issues with eLearn. But I will be on Zoom for the first 10 minutes. After that, I'll be off Zoom, but I will be on email. Usually, I don't sort of answer any questions during the exam. If there is an error, feel free to email me. I can look into it, but I did sort of proofread the questions, but of course, there could be an error. But if there is an error, just feel free to drop me an email. I will be on email during the time of the exam, and I can try to, maybe let you know, is that an error or maybe you're just not reading it correctly. So make sure that you're on email, but there's no need to be on Zoom. If you do have a technical issue, the first 10 minutes of the exam, I will be on Zoom. Chapter 4 homework due this Sunday, so make sure you get that done and submitted on time. And if you have any questions while you're studying, feel free to reach out by email. I'll try to answer your question by email. If for some reason we can't answer your question by email, we can always set up a Zoom session on Monday or Tuesday or Wednesday before the exam as well. Any other questions before we wrap up?